All right, so we are about to go. So hello all. I'm glad to see everyone here. So this is the Investors Club of TradeNet, and first of all, if you are new here, so just a couple of words about what is the Investors Club and how the Investors Club of TradeNet is going to serve you guys. So if you have an interest in the investment world or simply want to get unmediated professional insight into attractive and high quality Wall Street investments, you have the word to gain from TradeNet's Investors Club. Our Investors Club, which is running weekly, was created to help our large client base achieve their long-term financial goals. So my name is Shlomo Cooper. I'm a senior analyst here in TradeNet. I'm an accomplished trader and Wall Street investor, and at the start of each week, I will guide you as we embark on a wonderful and fascinating journey into the investment world. Together, our financial opportunities will become one and the same as I expose you to an investment approach that will put you on the right side of the map with the market and with the winners. So whether you are a day trader, whether you are a swing trader or long-term investor, your thirst will be quenched by the new investment opportunities that I place at your fingertips. Welcome to the Investors Club. So with another week in the books, it's time to take a look at what might roll the dice in Wall Street this coming week. We have great presentation for you guys. We are going to summarize what happened in April. I'll give you my focus for the market, where I think the market is heading, and I give you also 3 reasons I think it's the right time to jump on US stocks right now from the long-term perspective. Also, as we are doing it at the start of every month, we are going to take a look on the statistical table. This is the average monthly percent change for the Dow Jones throughout the history, and we will see what the month of May that we start right now, that we've started on Friday, is actually what we have there. What should we expect in May? Also, I'm going to give you a fascinating, I think it's a fascinating analysis on how the month of May typically unfold. So just think how precious it is to know in advance what to expect May to do, not just at the end of May, whether it's going to be a month with gains or a month with loss, but to know how May is going to unfold from start along all the month till the end. And this way we can actually gather a lot of information and prepare ourselves great, both for the gains and both for the losses that the market is going to carry with. We then are going to go to the NASDAQ. We are going, as we are doing every week, we are going to take a deep analysis, the deep technical analysis on the S&P 500, on the NASDAQ, on the Russell 2000, which actually collapsed last week, and if it was the best performer index from the start of the year, it actually gave this leadership to other indexes, and we are going to understand why and how that connects to the plunge in the dollar index in the last week. Also, I'm going to give you an argument why I think, lots of people carry lots of fear right now that the NASDAQ has stopped its last stop 15 years ago, the top of the bubble, of the dot-com bubble, and lots of people are asking themselves, investors which have open wounds from 15 years ago? Is it going to happen again? Are we at the edge of the cliff, and are we going to fall again? And I'm going to argue that this time the NASDAQ is absolutely different. One of the things that I think lots of day traders are overlooking is the crude oil inventories. So we are going to take a look at the crude oil inventories. This is a piece of news that is it's released every month on Wednesday, and a part of the fundamental approach, or the fundamental importance it carries with, I'm going to show you a great day trading technique that I'm executing every week. Now, I think most of the day traders don't know to wait for Wednesday, and what great opportunity Wednesday carry this every week. I'm going to teach you this technique and how that connects with the crude oil inventories that we are seeing every week. Also, we are going to take a look on the oil. The oil actually plunged. It's in a long-term downtrend, but in last months we see a turnover, and the oil is actually approaching the high of the year. Actually, I think it broke to a new to a new level this year, and actually it's up from the start of the year. So we are going to ponder whether the oil has more room to go up, or whether this is just a correction and maybe this is the best time to get short on the oil. We are going to see that. We are also going to take an analysis on the US dollar index, which is very important, and then we are going to also take a look on Apple. Apple great earnings, and why Apple actually went down, and how big is Apple. And you are going to see that the money that it has in its balance sheet is also larger than part of the biggest companies in the United States. Apple is a phenomenon, and we are going to devote some time also to Apple if we have time. So let's start, and I want to start with the month of April. And after a strong month, after a strong start to the month of April, the Dow Jones fell sharply over April's final week to close only modestly higher. Also, the S&P 500 went down, and it closed with gains of just a little bit below 0%. So here is a look at the April performance of key ETFs across all asset classes. And as we can see, actually the small cap, the IWM, the Russell 2000, this is the index tracked by the IWM ETF, that was actually the real underperformance late in the month, and have now given up all of the year-to-date outperformance versus larger cap. So right now we can see that the IWM finished last week with a sharp decline of more than 4%, and it's only 1.3% up since the start of the year, much less than the NASDAQ, for example, the QQQ, that is up more than 4% since the start of the year. Also, we can see, if we take a look at the sectors, energy and materials are the only bright spots right now. This is the XLE, the ETF that tracks the energy, up more than 6.5% for the month of April, and also right now April pushed this sector to be green for the year, up almost 5%. So let's take a look at the chart of the XLE. And we can also trade the XLE, and as we can see, it has here a nice double bottom, the ebb of December combined with the ebb of early January. So this is a great double bottom, and from there the XLE, the energy, is just pushing higher. And right now, at the last 2 weeks or so, we can see that it's stalling around the declining 200 moving average. Usually when you see a financial instrument very large like the XLE, or by the way any other stock approaching a declining 200 EMA, you should expect a stall around here. All right, so right now the energy need to gather its energy, need to take a breath before it can actually continue its great climb upward. So right now it's just sideways, but you know, this is a constructive action, price action for the XLE, and usually the resolution of such a pattern is upward. So I expect more gains for the XLE and for the energy stocks. Looking abroad, and by the way, you know, if the action we've seen over the last couple of days continues in the energy, it won't be too long before energy is the best performing sector on a year-to-date basis. And you know, and ahead of the XLE, we just have the XLV, the healthcare, which was a very strong sector since the start of the year, up almost 5% since the start of the year. And also the best one is the telecom, the IYZ, that is up more than 5%. The underperformer, absolutely more than anything else, is the XLU, the utilities, which is down more than 6%. So usually we have there we have the companies that investors put in their portfolios in order to take in order to harvest, in order to take dividends. Now that the Federal Reserve is about to increase its rates, we have the bonds will start shortly be an alternative to the dividends that the utilities are handing out, and this is why we saw a massive sell-off in the utilities since the start of the year. Looking on the global arena, and aside from India, this is the INP. India went down more than 5%. So the rest of the world has held up okay over last week, and for the month, countries like Brazil, the EWZ, which is up more than 50%, China, FXI, that I strongly suggested you to consider an investment there using the FXI, is up more than 15% since the start of April, and Russia, the RSX, is more than 15%. This is just in the month of April. Now, the RSX Russia was one of the underperformer last year for 2014, and right now since the start of the year it happens to be the best performer, more than 34%. And you know, investing and being active in the US stock market can give you exposure to anywhere in the world you just want to. So if I'll just take a look on the chart, just put here the RSX. This is a marvelous gain since the start of the year. We see here a very similar pattern to what we saw earlier on the XLE. These are charts that were just brutally went down, and now when they climb up, they are meeting the declining 200 moving average. We saw it in the XLE, now we see it on the RSX, and this is a problem. This is a very, very strong obstacle to overcome, and usually a financial instrument needs to take some time before it can leap over this obstacle, but usually more than not, we have a positive resolution around these levels. I want to get back to the US market, and this is the SPY that tracks the S&P 500 index, the daily chart. And you know, I like US stocks right now, and it's right now and right here. I don't think we need to wait much longer to have a decision whether we want to invest on the S&P or on the long term or not. I think for the long term, this is the time to buy US stocks, and I will give you 3 reasons why I think now it's a good time to jump into stocks. And you know, I'm just telling you about my long-term perspective. So first of all, the growth in the US market is going to accelerate, and GDP growth this year will mirror, I think, what we saw back in 2014 last year. There will be modest growth in the first quarter, and the GDP that we actually got last week showed a very, very modest growth of 0.2%, just 0.2%, but we are going to see an acceleration in Q2 and in Q3 when setbacks like unseasonal weather fade away. Also, bottom-up earnings. Bottom-up earnings are aggregate of all individual equity analyst forecasts, and these estimates are just way too low, which is rare. It's only happened some 6 times in nearly 40 years. So the multiple typically climbs when bottom-up expectations are raised. My earning forecast for EPS is $124 for all the stocks in the S&P 500, and right now the EPS expectation of the market is only $119. So that means we have much more room for US stocks to climb at the rest of the year. And the third reason is investors are not in love with stocks yet. Investors aren't overly upbeat with US stocks. Net hedge fund exposure is sitting at its 5-year averages, and this is when the market is very, very near its top. So there is much more room for the hedge fund to take much larger exposure to US stocks, and that gives headroom for growth in the price action for stocks. We've just entered the month of May, and you know, one of the expression that you are going to hear over and over is sell in May and run away. And you know, just type on the keyboard that I will able to interact with you. How many of you have heard in the past about sell in May and run away? And you know, how many of you are going to run away from the market, guys? So let's hear you. Okay, give me a sign. It's very, very quiet here. All right. Okay, so here you are. Okay, several times. All right. Yeah. So as we do at the end of each month, here's a look at monthly seasonality trends for the market throughout history. In the table and in the chart, we highlight the average returns for the Dow Jones average by month over the last 100 years, 50 years, and last 20 years. We also include here the percentage of the time that the Dow Jones has been positive by month over the 3 time periods. So if March and April, all right, they are the party months for the market, as we can see that usually the Dow Jones in the last 100 years on average went up 0.65% on March, or more than 1.3% for the month of April. And by the way, the performance was much stronger lately in the last 20 years, as we can see. When it comes to May and June actually represent the hangover of the party months. So over the last 100 years, we can see here the Dow Jones has averaged a change of 0.01% in May, with positive returns in only 53% of the time. Over the 50 years, the Dow Jones has averaged a decline of 0.15% with more losers months than positive months. And over the last 20 years, we've seen the Dow average a small gain of 0.17% in May, with positive returns exactly half of the time. While May has been May decor at best throughout history, as we can see here on the table. June has been negative at least half of the time over the 50 and 20 years in last history. So there is a reason they say sell in May and run away, and these seasonality trends are the reason. And you know, savvy investors are using these tables and these statistics in order to track the market and in order to take decisions about what is going to happen in the market. While actually selling out of your portfolio isn't the best course of action, all right, you don't want to base your decision just on the past history. Just keep in mind that the next 2 months, May and June, historically haven't been a great time to go out and take on more longs, but you know, but we need to every time to consider what happens right now, and also from the long term, also to see where the market is going to be at the end of the year, not just how it's going to mess around in May or in June. Now, I want even to take a deeper look at what is the pattern of the month of May and how things are usually goes around. So, and would it be, you know, something great, something extraordinary, if you could not only know where May is likely to be at the end of the month, but also to know how the month of May is going to behave along the month. So you will know all the tiny parts that create eventually the whole. Or in other words, wouldn't it be a great tool to know how typically the month of May is folding out from the start point to the end of the month? So this is exactly what we are going to see in the following chart using a large intraday database our fellows in Bespoke created. So they actually created a chart of the S&P 500 during the month of May dating back to 1983. In order to create this chart, they calculated the month-to-date change for the S&P 500 at each minute throughout the month for each year. Then they calculated the average month-to-date change at each of those 1 minute intervals to create these three charts we see in front of us. As you can see on the chart, the S&P 500 has averaged a monthly gain of 0.04% in May since 1983. This is the green line, which is better than some of the longer dated May trends I've just pointed out on the prior table. Looking at just the last 20 years, which is the blue line here, and go on this chart together with me, the average return is less than half of that at 0.45%, although that is still nearly 3 times the average return of the Dow Jones over the same 20-year period. As we remember, we saw here, over the 20 years period, it's only 0.17%, so it's much better for the S&P 500. And finally, over the last 10 years, this is the red, the red chart, the red line here, the S&P 500 has averaged a decline of 0.21% in May. So more recently, we can see clearly the market has struggled during the month, but don't give up yet. What stands out about these all three charts is that positive returns for May are back-end loaded. For each of the time periods shown, the month starts actually off flat, sells off. This is where we can see the sell-off in the middle of the month, and then rallies in the final week of the month on the whole three time windows. So, you know, what we can say about the month of May is not sell in May and run away. Maybe you should sell at the start of May, but don't go too far away, because you need to get back to the market, because you don't want to miss the last week of the running. On the next chart, we have summarized those results for each of the time periods shown in the previous chart. So since 1983, this is all the circumstances for the month of May. We actually, divided the month to date through the 24th of May. This is, where the month starts off flat and then just sell off. And then we wanted to see what is the return on the S&P 500, what is the performance of the S&P 500 for the last year, for the last week of the month of May. And you just need to cut this slideshow and put it on the side and pull it back when we will come in another 3 weeks or so to the last week of the month. And this is something very, very interesting. The S&P 500 has averaged a gain of 0.32% for the month through the 24th of May, and then surges an average of 0.73% in the last week of the year. Isn't that astonishing? Over the last 20 years and 10 years, the returns are even more divergent, with the index averaging a decline of 0.07% in the last 20 years and 1.25% in the last 10 years for the first 3 weeks. But then we have here a great recovery where we have the last week of the month, the index averages gains of 0.54% and 1.06% for these years. So while you may want to sell in May, don't go away for too long. This is what we can understand from this analysis. Let's get back to the S&P 500, and as we are doing each week, we are going to take a deep analysis into the technical analysis, into the how the chart is right now looking and what should we expect in the week to go. So a strong, and I'll just zoom in here, a strong start on the first trading day of May. All right, and this was on Friday. All right, and this is exactly the horizontal line that divides the end of April and the start of May. And actually, we can say that the first day of May saved the week for the market bulls. After negative action over the first 4 days of the week on generally weaker than expected earnings and economic data, the S&P 500 bounced back above the 50 days moving average. This is the green line I'm using right now on the daily chart, and it remains within its uptrend channel. Now, despite last week's decline, the S&P 500 continues to trade in an ascending triangle, and I'm going to try to just sketch here in on the chart. So this is this is the pattern, the ascending triangle. So we have here a line that connects the tops of the market, and then we are going to connect a line. This is the uptrend channel that connects all the recent ebbs in the market, and see how many ebbs this line is connect together. This pattern is characterized by, as I say, horizontal resistance level. This is around 212.5 on the SPY, the ETF, on the one hand, and on the other hand, we have here the uptrend line produced in starting actually in mid-October. Okay, we can also connect this line of last year, passes through a number of this year's low point. As long as the index succeeds in being supported on this line, the assumption has to be that a significant breakout to an all-time high will be a matter of time. Usually the resolution of such triangle patterns are to the upside. A breakup of the 212.5 point level regarding closing prices will attest to the market leaving behind its sideways trading on the way to a significant wave of gains. Let's go to the weekly chart, and on the weekly chart we can see the market is just going sideways for the last couple of months, and this is exactly how the triangle is created, and all the volatility is shrinking until it's going to burst up. Usually it's going to burst out to the upside. Also, I want to go deeper into the 30 minutes chart, and this is something I showed you last week, and I'm going to show you each week. I'm using the 5 minutes, the 5 days moving average on the 30 minutes time frame, and this is, as I concern, this is a long-term chart for the day trader. So as long as we see right now a declining 5 days moving average, we have to regard the market as guilty till prove otherwise. So we saw that the market went down on Wednesday below the declining moving average. Then it tried to retest this line, but not was able to go above this. It just went out on a sell-off all through Thursday. Now on Friday we saw a recovery, but in order to have a confirmation that the market is going to turn around and it's back again, trying to reach its top of 2015, we need to see maybe a following through, maybe a little bit of rising here. Then I would like to see a little bit of a pullback, and then I would like to use the retest, the reversal that may be created here as a long signal for this coming week. So just keep it in your mind. As I see it, stocks could continue to be volatile as the market weighs each key economic report and what it means to the Federal Reserve. The market for now expects a rate hike by September at the earliest, and most likely by December. So I think the trend is still higher, as we saw earlier on the daily chart, and I'll get back to the daily chart. There is a ton of liquidity, and we are invited as investors to take risk. So it's more of the same until we start to close in on September, or we start to see stronger economic results that suggest the Federal Reserve is going to move sooner. Then maybe we will see some fear getting into the market. Let's go from the S&P 500 to the NASDAQ. This is the ETF QQQ, which looks much better. It's not going here sideways, not at all. Right now on the NASDAQ led the move lower this week, last week, but immediately pulling back after it made a fresh all-time high, closing high above March 2000 levels last Friday. But after, it just I'll just take the daily chart with all the moving average I'm using it to see. So it just once again. Let's take the NASDAQ back again. All right. So it just was able, with 4 days of declines, to reach the rising 50 moving average as it did lately. It found their support and a bounce back quickly back above its 50 days moving average on Friday to close out the week on a strong note. So the uptrend here remains intact. Now, looking on the NASDAQ, I want to give you another reason why I think, although there is a lot of fear among investors that right now reaching the top of the 2000 bubble It's all, you know, maybe we are going to see it once again, or the declines and or the falls. I want to argue that this time it's different for the NASDAQ. So as the tech dominated index approached the 5,000 mark last month, some analysts and some investors argued that this is a repeat of 2000, when stocks were overvalued and the NASDAQ tumbled. Traders, but traders today are not, and this is one thing that diverges between these two times. Traders are not as confident that stock valuations will continue to climb higher as they were at the NASDAQ's previous record high. So this is a very interesting chart, tracks the NASDAQ as well as the investor sentiment at the bottom of the chart. Now, this is the American Association of Individual Investors. This is an index called the AAI, Individual Investors. This is an index called the AAII, and it surveys the direction that investors are betting stocks will go in the following 6 months, and just show and just see how the price action of the NASDAQ play out together with this sentiment index. So the NASDAQ composite right now at the top of the bubble also grabbed here a very high bullish reading for the AAII. All right, so everybody was very confident that the stock market is going to push higher when we got to the top last time in March 2000. Now that we actually climbed a little bit above the prior high of 2000, look how the AAII sentiment index went down. So today people are not as confident as they were last time. Now usually you are going to use this index inversely. That means when you have here a high reading, you are going to be bearish on the market, like it was on the NASDAQ 2000. And when you have here a low reading, that means all the investors think the market is going to collapse. This is where you have to embrace the long standpoint. So right now we can say that the NASDAQ stole many headlines last week as it actually went above its prior peak some 15 years earlier, but I believe the orderly process, see how orderly process we had here with the price action and the lack of extreme optimism from index sentiment actually will allow price to continue in its advance going forward this year, and the technically trend and the internals are more constructive right now versus what we saw at the 2000 top. Let's go also to the IWM. The IWM is the ETF that tracks the Russell 2000. These are the smallest. These are the small caps, the smallest stocks when we calculate its market cap, and this is the one index that failed to move back on Friday. Failed to move back into its uptrend channel on Friday, and as we can see here on the chart, this chart is on shaky ground right now. It doesn't have a much support in sight at current levels, aside maybe from a 119.42. This is the ebb around mid-March, but a part of it has a lot of room to go down, maybe even to visit the 200 rising the 200 moving average, the rising 200 moving average. You know, after finally outperforming in Q1, and this is what we saw for January, February, and March over the large cap. Right now, we see that investors in previous week just exited small caps rapidly, and this is because of the weakness in the dollar. Small caps in the US generate the bulk of the revenues domestically, so they are more vulnerable to weakness in the dollar than large blue chips. And we are going to see the dollar index, and how the dollar index is performing in a couple of minutes. Let's go to crude oil. And in the crude oil, I want to show you a trade that I'm taking as a day trader every Wednesday. So this is a weekly trade I'm doing every Thursday, but in order to understand what I'm looking to and how actually this technique is working, every Thursday at 10:30 Eastern time, let's just take a previous look, a look previously on the crude oil inventories. If it's Wednesday, you know that the crude oil inventories is on the deck in the economic calendar. And right now, the crude oil is on rising. So last Wednesday, weekly inventory report, it comes from the Department of Energy. It showed that crude oil inventories rose for a record of 16 straight weeks. This is a lot. 16 straight weeks. We see the inventories just climbing up. And what was somewhat of a surprise, however, was the fact that stockpiles rose less than expected. So, and this is a start. While traders were expecting crude oil inventories to increase by 2.5 million barrels, the actual increase was around 20% less at 1.91 million barrels. Even with the smaller than expected build in stockpiles, inventories are still at a record high and close to 150 million barrels above the historical average for this time of the year. So if we can see here, this is the gap. This is the difference between the 215 inventories till this time on the year, around the end of April, and what happened on average in the last 10 years. This is the orange line, and what happened on the red line, which is the average of inventories since 1983. Looking at the historical trends, however, we should begin to see inventories draw down in the weeks ahead, as stockpiles typically peak for the first half in early May, and then they are going backwards. And this is because we are heading into the spring, and usually, for example, factories need to put much less energy into lights in the factories, and they are using less energy. Also, we at our houses, we don't need to put we don't need to heat the house, as we are usually heating the house and using energy and using oil for that during the winter months. So this is exactly what I'm calling seasonality, and we have seasonality not only on the calendar of the year regarding stocks movements, as we saw what typically the month of May is carries on with him, but also when it comes to crude oil inventories. Now, when you have such a large oil in the warehouse of the oil companies in the United States, of course, this is giving a very, very high pressure on the price of oil. Although the price of oil actually went up, it went up against a very, very strong headwind coming from the rising oil inventories. So if we are going to see a fall in the inventories in the coming weeks, of course, this is going to be a very good tailwind for the oil price, and this is why I think the oil is actually going to go much higher. Now, one thing that I'm doing every week is, and I'll start it otherwise. Lots of investors and lots of traders are actually asking me, as a day trader or as investors, how much weight to put into the analysis from the technical standpoint and from the fundamental standpoint. Now, of course, as we go and making analysis or making bets on the long run, all right, the longer the time window we are using, we need to put into the equation much more fundamental analysis. You know, if you are going to buy Apple or if you are going to buy Microsoft, or for the long term, you need to know what you have into your portfolio, all right, what you are holding, what are the economic figures, what are the earnings, what is the growth of the company, all the fundamental factors to know that you are holding a quality investments in your portfolio. And even if the market is going to have, it is going to struggle or is going to have some difficult times, your investments is going to overcome this turbulence in the long run. But when we come to day trading, where this is exactly what we are doing here in TradeNet's room, when we are day trading, we put much less weight on the fundamental point of view or on the fundamental figures, and we are putting much more consideration for the technicals, or if you want, for what I call the trading consideration. All right? Now, although we don't put a lot of fundamental into the day trading, the fundamental does have it does have the room. And the room we need to give to the fundamentals is just as the trigger for something. So, you know, every day we are releasing here the TradeNet's daily report. This is the report that our analysts are writing, and you have here the economic diary. And one of the things that I want you to do with this diary, with the economic diary, is to understand how the economic news are going to affect certain stocks or certain sectors in the market. And the crude oil is a great thing to start with. Say that you know, and if you have our economic calendar, you do know it. You know that each Wednesday at around exactly at 10:30, the energy department is going to release the figures on the crude oil inventories. Now, I'm not expecting you to be I'm not expecting you to be an economist. You don't need to analyze these figures. You don't even need to understand what the analysts are expecting and what is going to be at the end the actual figures. Well, I just want you to be ready for a movement. In this case, a movement in the energy sector. So let's go to the energy sector and see what happened last week, 2 weeks ago, 3 weeks ago, when this report actually went out. So I'm going back to the chart, and I'll take here, just load here, the 5 minutes chart, and let's go back to the XLE. Okay, the XLE, again, this is the ETF that tracks the energy sector, and last Wednesday was the 29th of April. So I'm taking the chart back to the 29th of April. All right, and you know, this is a great technique I'm using every week, and I want you to start using and get used to for this way of thinking. So actually, 5 minutes. Look here. 10:30 on the clock, all right, exactly 10:30. What you see here, all right, you see here what I call a boom bar, all right. This is a very large, high, tall green bar. Also, look what is happening here on the volume. This is at the middle of the day, 1.5 hours, 1 hour after the start of the day, and we see here a spike in the volume. So there's a lot of energy coming into the energy sector. As I told you earlier, the reason for that was the figure actually beated the expectations of the analyst for the inventories. But you don't need to read news. You don't even need to understand the news. All right, because my news reader is the charts here. All right, is all the bars that I see, all the bars that are being printed here on the chart. So I'm just waiting for the first reaction. The first reaction for the oil inventories is a green tall bar. All right, usually there is going to be a follow through till the end of the day, and as we see after the first reaction bar, this is the first reaction bar, we see an uptrend till the end of the day. And actually we can see that the news release actually flipped over the old downtrend that was previously dominated in this chart. Now you can use the XLE to make a move, all right, as a day trader, just to buy the XLE, putting maybe a very small, tiny stop loss below these two tails, two bottoming tails. But you can also, why to take the all average, why to take the all index when we can just ride a very specific and speedy stock, individual stock. So what energy stocks do you know? Are you familiar with some stocks? And we'll just put them on the chart. We'll just put them on the chart, and we'll see how these specific stocks actually reacted to this news release. So I'm happy to go with that. I'm happy to start. And the first one, let's start. Let's try PTN. PTN is one of the oil stock that I like to follow. So I'm putting here PTN. And look what happened in PTN. This is great. This is the first reaction bar to the inventories. All right. Using this bar as a reaction, you understand that this ignites a movement. All right. And then we see a great following through. And here from 2180, you could have all the movement up to 22.8. So this is a great movement. Let's see what other oil stocks did. Let's put here APC. All right, APC, another stock, another oil stock. This is the reaction bar, 10:30 exactly on the clock, and then we see a great movement upwards. Also APA. So usually what a great movement on the APA. So maybe around 10:30, you just let this let this bar develop. Then you see here a very small pullback, and then you use maybe the view up to take a reversal, and this is a great movement, a movement of a couple of dollars coming from the fundamentals. All right, so the fundamental news actually triggered here the great movement upwards. Maybe this is only a very maybe this is only particular to what happened last Wednesday, but it doesn't happen every week. So this is exactly the time to examine how it happened on other Wednesdays. So I'm going to take the XLE to examine it on the 22nd of April. Let's get back to 22nd of April, another Wednesday. Okay, and again we are waiting on the 22nd of April, 10:30, to have the inventories release, the oil inventories figures. And again, a spike in the volume. This is the reaction bar. This is a positive reaction bar. Then we have the follow through. Go back with me to another Wednesday, and I'm just going to flip to the 15th of April, another Wednesday, 15th of April. Okay, and again, the power of this technique, you don't need to expect ahead of the time what the movement is going to be. Look, on the 15th of April, the XLE starts off the day with a gap up. It's going up, but then it's really gathering all the energy. 10:30. This is the release of the oil inventories, and from there it doesn't look behind, just just going upwards. This is a gap and go all the way. Let's take even another Wednesday, all right, just to show you how powerful this technique is. I'm going back to the 8th of April. Okay, this is that was the first Wednesday of April, and this is a negative reaction bar. Up until now, all previous Wednesday carried with them a positive green bar in reaction to the oil inventories release. But here we see a very large bearish candle, a very large red candle. So, I'm not trying to predict what the reaction candle is going to be. I'm just waiting it to be complete. And once it's complete, I'm pulling out the trigger. I'm pulling out the trigger according to the signal I'm getting from the reaction bar, in this case to the short. Now, you can short the XLE if you don't have any specific energy stocks, but I highly recommend you to have a drawer, to have a box with stocks to a drawer with stocks that fit to a specific sector like the energy. So if I want to pull the trigger on the energy sector, then I know exactly to look on APA, to look on APC, to look on CLR. CLR is a great mover in the oil space. Also, we have a PTN, as I mentioned. Usually, I'm not using the XOM, ExxonMobil or CVX, as they are, the most heavy stocks in this space, and they so they are very, very lazy, or very heavy to move. So this is a great technique. Use it. This is where I'm making money every Wednesday. I just want to finish with the oil. Just look how the oil is performing. So as we can see here, oil has clearly broken its downtrend. I just put here the downtrend, all right? So this is the downtrend that actually accompanied the whole plunge in the oil in previous months as the oil plunged, but actually it has clearly broken its downtrend at this point, and it has formed a short-term uptrend. All right, a short-term uptrend of its January lows. Just last week, we saw oil take out resistance at its prior 2015 highs, so the long slog back towards higher levels continues. I will certainly see downside pressure as longs look to exit their positions as they get back in the money, but at this point, I would play oil from the long side unless it ends up breaking its prior lows of March. This is a long, and the oil has much more room to go up. Hopefully, it's going to break. It's going to break out the $60 level and making a new high for the year. As I showed you earlier, the oil is actually up for the year. Also, as we analyzed earlier, usually this is the time around the calendar where the oil inventories are starting to go backwards, to go downwards, and this is a tailwind for the oil, as the inventories are expected to go lower from this level. Hello, Justin, and welcome aboard. Right now, this is the Investors Club. We start every week with the Investors Club. Right now, I want to finish our meeting for this day. We are making here some more room for the day trading action to start, and in a couple of minutes, Scott is going to take the microphone, and he's going to lead you and direct you in what the market is going, what we are going to see in the market today, and how to prepare ourselves for today's action. Also, we are going every day to see here the best stocks that we expect them to explode higher, or maybe to plunge lower, and then we are going to take here in the room great stock picks. This presentation is going to go online, so you will have the whole time to just replay it on our YouTube channel. So I want to wish each and everyone here a great success in trading and in the investments this week. Hopefully this is useful information that we are bringing you. As usual, just email me at shlomo@tradenet.com if you have any suggestions, comments, or anything else you want to see in this Investors Club. My wishes are going to you guys. Hopefully this is going to be a great first whole week of May, and I'm giving the microphone back to Scott. Bye bye all.
Shlomo, thank you so much. What a great presentation to kick off the week here. And traders, as you know, Shlomo had pointed out that this is going to be happening for all of us on a weekly basis every Monday morning, starting at 8 and running somewhere between 9:15 and 9:30. And it gives us a really good indicator of, kind of where we've been, looking at a lot of the different intricacies of the market, and coming from a perspective of a professional trader in Shlomo with a lot of experience. And you can see all the time and energy that's put behind the presentation here this morning. So Shlomo, I'd like to say thank you once again for starting us off this morning and getting us pointed in the right direction. You're welcome. And now what I'm going to do is I'm going to pause for just a couple of minutes here. I just have to get a couple of stocks input into my charts, and I'll be right back, and we'll get this this Monday morning working here with the morning launch and take everybody through to starting this week off in a positive manner, and make a few announcements. We're coming off of a great week, a great trading week, a great profitable week. So nothing that I see would get in the way of having that same type of performance this week. So just give me about 3 minutes here, and I'll be right back, and we'll get things started.